there's a couple of important things to realize here. Let's be clear, it was not a good report. All the subcomponents, or most of the subcomponents, were all weaker than they were in the prior month, the one standout being employment. But it was not a good report. But to me, the most important point to remember here, above all else, is that even at the number in which it came, which was lower than expected, it's still very elevated. And in relation to what we've seen over the last 20, 30, 40 years, the likelihood of higher readings at this point in the cycle are quite low. And so to some degree, we should be expecting readings in this range over the coming couple of months.
I think the most important thing that we can do right now is not get too overly focused on what happens in the first few days. Really important to remember that in 2014, we started off the year with a 6% peak to trough sell-off in the S&P and ended up not being meaningful at all.
I agree with Josh. We can't make much of these trading sessions, even what happened in the last trading session of the year and coming into today. Investors are still trying to figure out exactly how to play this new year coming in. And clearly, the movements that we've seen in oil over time have moved investors really away from focusing on the true fundamentals of the market and only focusing on oil and energy stocks right now. So until we see some stabilization there, I think we are going to see some of the players who've been waiting to get back into this market still stay on the sideline.